Hello, and welcome to the Weekly Watch. I'm Brian Daingerfield, the co-head of G10FX Strategy at NatWest Markets, filling in for John Briggs. This week, all eyes were on U.S. CPI. The U.S. CPI print would be critical both for the near-term and medium-term Fed path. Federal Reserve officials, including Chair Powell at his recent Jackson Hole speech, have been talking a lot more about wanting to see inflation come down in a persistent and meaningful way, looking for multiple months of consecutive improvement on the inflation front. With that in mind, the prior month's inflation print was actually a little bit softer than expected, and expectations were that this number might also come in on the weaker side compared to earlier prints this year. With that in mind, there was some expectation that perhaps inflation could allow for the Fed to start to slow down its pace of rate hikes at its upcoming meetings or perhaps later this year. But instead, we had a much stronger than expected CPI print, particularly on core inflation. And so to break it all down, I'm very happy to be joined by our chief U.S. economist, Kevin Cummins. Kevin, thanks for joining. I want to start by talking a little bit about the core CPI. Now, not only was the core CPI much stronger than the market expected, the breakdown of the CPI was also something that was pretty notable in that some of the stickier, maybe more persistent categories were the source of the strength. So could you just break down what you saw in the inflation numbers and how the breakdown between headline and core is influencing your thinking here?
Yeah, thanks, Brian. And I think you hit the key part here is that not only was it surprising relative to expectations, but some of the components that probably will persist going forward were a problem. And the fact that rent prices, in particular, both the residential rent and the owner's equivalent rent, which make up about 40% of this core CPI, surprise to the upside. And those, as you say, are a stickier component, so that, we may have not seen the worst of their upward move that we saw. So in the wake of that, we did alter our forecast going forward. And as a result, the core CPI is likely to end this year, based on our projections, above 6%. And we had it at about 5.5% on a Q4 over Q4 basis. So it was a pretty noticeable upward revision of our forecast. And in turn, we now think the Fed is going to have to front load even more policy and probably push up their markers for where they have the terminal funds rate when we get the updated dot plot at next week's FOMC meeting.
So in terms of the FOMC, is this something that you think locks in 75 basis points at their next meeting? And what do you think it means for the FOMC for the remainder of this year?
Yeah, it's a good question. I mean, immediately after the report was released, the debate of whether it's 50 or 75 got thrown out the window, and it turned to 75 or 100. Markets didn't initially price it in. We put the odds pretty close to either a 75 or 100 basis point move. A lot of Fed officials have been talking about and in favor of front loading the amount of action they're doing, with the hope that they don't have to potentially do as much later on down the road, that they might as well get it over with now. And it's a valid case, although, the moves that we've seen, the back-to-back June and July 75 basis point moves are pretty unprecedented, and 150 basis points in two moves is quite a significant move. So I think the CPI report, while it kind of seals the deal for continued supersized moves, markets now are pricing in about an 80% chance that we're going to get a 100 basis point move. So it may very well be, if these sort of odds going into the meeting, that the Fed is going to follow through. And I think they would run the risk at this point in time, if the odds are that high by the time the meeting comes around, that they don't want to be seen as under delivering. The Fed has emphasized, and I think this is something that Powell will emphasize, is we're going to take whatever it takes to get done to get inflation back down at 2%. So they're determined here. Whether or not they want to change that path going forward, it does complicate the messaging a bit if they were to amp it up again. And I don't know if you're going to have quite as many. It's going to be a little bit more difficult to build a consensus around 100 relative to 75. So I think it's probably a safer bet from their perspective to go with 75. But if the market is pricing in as strong odds as they are right now, it's going to be hard to not do it and just signal that this sort of path forward isn't, is to be expected, that they're going to have to start, tamping it down to some extent. At some point, they're going to have to slow the pace of hikes. And that'll be a little bit more explicit, I think, probably in the statement if they were to go ahead and do a 100 basis point move. Either way, I do think that we'll probably hear from potentially an article in the Wall Street Journal and just kind of giving enough guidance ahead of the meeting exactly how they feel. Because up until now, we haven't really had any sort of, given the blackout period, any sort of guidance from Fed officials. So that would be a kind of a clear indication of what to expect ahead of that. So
I think that's right. And one thing that I think is super interesting as well is this idea that the Fed wants to see consistent progress on inflation. I almost feel like the CPI number this week essentially reset that count to zero. That rather than seeing, Powell said it himself that the July number was a step in the right direction, but certainly not enough. One print does not make a trend. It seems like there's so much volatility in the CPI numbers that you could have a 0.2 and then a 0.6, for example, on the core CPI, that's something that could realistically happen. It just feels like the volatility in the data, not just in inflation data, but also in some of the PMIs and others, it's going to make it really challenging for the markets to interpret the Fed and for the markets to understand what the Fed is doing, because the Fed is relying on this data and this data feels very volatile. Is that something that goes into your thinking? And I mean, I think about the following meeting in November. Do we already have to lock in a higher pace of rate tightening because they simply won't have seen enough progress by November, having had this print as strong as it was?
Yeah, and I do think you bring up a good point. I mean, for a little while there, it did seem like the Fed was basing policy on one number, and I don't think that's the approach that they want to take. Powell in July sounded a little bit more nuanced. He talked a little bit more about the labor market, and he wants to see the unemployment rate go higher because he wants less, to provide less tightness in the labor market and to provide some slack there. Because I think that's very important that I obviously right now it's not time to worry about over tightening, but if you're basing your policy solely on the core CPI and whether it comes in 0.6 or 0.4 or whatever it is in a given month, you're basically assuring that you're going to over tighten later on down the road. And I don't think they want to go on that route. So we've heard a little bit of a shift that they're going to be more, looking at output and the unemployment rate. Clearly, inflation is on the minds of these guys, and they're not going to stop, and they're going to get the job done. But if they were to kind of continue with another 75 basis points in September and another 75 basis points potentially in November, that they'll still get to that higher level. They just don't know what that level is. And as we've gone on, that bar for the bigger hike, I think, one has to realize that the hurdle is higher because now you're into restrictive territory. And so far, you haven't seen any real spillover to the labor market that the earlier tightening has taken place. I mean, even this morning, jobless claims, while it was a week of the holiday, jobless claims are running at a still very low level and still consistent with the idea that you have a very tight labor market. Job openings have started to pick back up. So, your unemployment rate is through the natural rate of 4% is the Fed's estimate, and you're at 3.7%. So wages are moving in the wrong direction. So I think the Fed is committed, and they want to emphasize that they're committed, and they'll do whatever it takes. But the movements of one reacceleration after a slowing is a little too cute from the perspective of like tinkering so much in response to a stronger than next month. It could be lower, it's softer. So I think the message is that they'll probably raise their terminal rate as of June. In July, he said that would probably be a pretty good format. But now I think that the fact that the persistence that we saw in this inflation report suggests that they're going to have to hike that up probably to somewhere around 4.5% by next year. And that would signal that this is, their tightening campaign isn't close to being done. They're only at 2.5% now. And if they got to go to 4%, they're 4.5%. They're, got another 200 basis points in expectations of raising the funds rate. And if anything, from a risk management standpoint, I think they want to keep going. And the risk is on the higher side because of those things that I just described.
That makes a lot of sense to me, certainly. The Fed, they're really fighting against the devil they know, which is inflation. But you mentioned the possibility of over-tightening, and almost the way the Fed is responding to current inflation seems to push them in that direction, that they would rather be over-tightening than under-tightening. I think that's a message that the Fed has been telling us about, talking about allowing or encouraging a slowdown in the labor market, a slowdown in demand to meet with supply. Are you worried about over-tightening? What is our outlook for the U.S. economy from here? And with this extra expected Fed tightening, are you worried that the Fed could be moving us towards a slowdown or even a recession even faster at this point?
Yeah, I mean, I think the more tightening is in priced in and expected from the Fed, it's probably going to be a little bit more painful. The unemployment rate could rise above where we have it at 5.5%. Eventually, it's a lagging indicator, so we don't have it up quite that high until 2024. But it is likely to move up once it starts going. So we have a shallow forecast for a contraction in output. So we are technically forecasting a recession, and this would just exacerbate and lend support to the idea that potentially it could be a little bit of a steeper drop, assuming that inflation doesn't move down as quickly as the forecast expects. I mean, we have inflation remaining above 3.5% or so, looking at the core PCE, well into next year, into the first half of the year. So that's going to keep the Fed hiking. But if we're wrong and inflation continues to move higher, those odds of a recession and the steepness of it just go higher going forward.
Thanks very much, Kevin. Just to follow up, the FOMC certainly feels like it is the most important, the key event of the week in markets, of the week ahead, I should say. But they're not the only central bank that's having an important decision. You also have the Bank of England, who's going to be making their first decision on the heels of the significant fiscal stimulus that was announced under the new government. And you also have the Bank of Japan decision. You talk about a central bank that is zigging when everyone else is zagging. The Bank of Japan has kept rates extremely low. They've actually maintained their zero interest rate policy via yield curve control. Certainly some interest in whether or not that will change because of significant weakness in the currency and some higher inflation expectations. Certainly plenty of interest in that in the market as well. So it's going to be a very big week ahead for policymakers. Thank you very much, Kevin, for joining and breaking down the Fed for us. And thank you to our listeners for listening to this week's Weekly Watch. If you enjoyed this podcast, please consider liking and subscribing to our channel for additional NatWest Markets content. Thank you very much.